Hi everyone, and welcome to today's video where we are going to be covering Roth conversions. My name's M Stackhouse, and we're going to go over 5 things in this video. We're going to talk about what a Roth conversion is. We're going to do some tax implications and compare those between an IRA and a Roth. We're going to go through a step-by-step guide on actually how to complete a Roth conversion. We're going to review some rules and limitations around Roth IRAs in general, and then do a pro and con comparison between the two. So let's dive in. In order to explain this concept, I need to make sure we all understand exactly what we're talking about. So a traditional IRA is funded with pre-tax dollars, meaning the dollars go in are never getting taxed. So then when you pull them out at retirement, you would be taxed at that time. There are going to be required minimum distributions that could be applicable to IRAs. Those are just the government saying, hey, you're old enough, you need to start pulling money out of your IRA if you have not done so already. That's going to be 73 is the current age. I know that's going to be increasing to 75 by the time 2033 hits there, if in the event you're turning 75 after 2033. Now, a Roth IRA, that's going to be the opposite of an IRA, meaning you're going to put after-tax dollars in there, meaning money that's already been taxed. And then the contributions are not going to be any tax deductions or anything along those lines, but the money is going to come out tax-free. Tax-free is highlighted in green bold letters because that's a big deal in my opinion. There are also not going to be any required minimum distributions that are forced upon you with a Roth IRA as well. Now, the topic of today's video is a Roth conversion. It's where you're actually moving the money from your IRA into your Roth in a sweep. So it's more or less going to be taking money and taking it from a tax deferred account and moving it to a tax-free account. So the next page, we're going to be talking about an example of what one might gain or benefit from a Roth conversion. So let's say John, this is a hypothetical John here, John Smith, has $50,000 in an IRA. He's wanting to convert to a Roth IRA because he is expecting taxes to be higher in the future than where they are now, and he doesn't want to be told when he has to take money out of the account. I've heard both sides of the argument of we don't know what tax brackets are going to be in the future. I just like to pull up this chart that I found a couple of weeks ago, actually, that looks at what is the top marginal tax bracket and where does it fall, and then look at the lowest marginal tax bracket. We are at historically low averages, in my opinion. So with that being said, we might expect to be paying a higher tax bracket in the future. So you might want to consider paying taxes on your money today to have it tax-free down the road. So how it might work, let's say John does convert $50,000 of his IRA into the Roth. He is going to owe taxes on that money in the year that he does that. So let's assume he does it on December 18th, the recording of this video in 2023. He's going to owe taxes for 2023 that it's going to look like he made an extra $50,000 on his paycheck. So if he is in the 22% tax bracket, we know he's going to owe approximately $11,000 in federal taxes from this transaction. Now, talk with your CPA to make sure that this is applicable to you, but I'm giving an example of how John's situation could look. Now, the future growth on that money is all going to be tax-free. So let's assume that account grows to $100,000 by the time John retires and he wants to start pulling the money out. He's going to owe a big fat zero on taxes to anybody for the rest of his life on that money. So that's the big advantage investment income-wise. Now, comparing to the IRA, if John left it alone, you can invest them both exactly the same. Except for John, his account would have grown to $100,000, but by the time he retires, he's going to owe taxes on that money. Let's assume he's in a 22% tax bracket at that time. Well, if you're just calling them equal, well, one account you only paid 22% on $50,000, the other account you paid 22% on $100,000 over time. So that is one of the big advantages, in my opinion, of a Roth conversion. Now, the long-term benefit, another long-term benefit you would receive is you know what you're going to pay today on your taxes, whereas in the future, we don't know. That's kind of the gamble with this, is determining, are we going to pay higher taxes today, or are we going to pay higher taxes in the future? Now, the step-by-step process on how this works. So first things you're going to do is you're going to determine if this idea is applicable to you. So again, please contact your financial advisor, your CPA, accountant, whomever it is that you work with on these ideas to make sure it's applicable to you, or our contact information will be below if you would like a complimentary consultation on this type of information. Now, you'll want to assess where you are now. So what do we think tax brackets are going to be today? Well, we know what they're going to be today. What do we think they're going to be compared to in the future? And then understanding what tax implications you would owe. Fun fact, it is not suggested that you use your Roth to pay the taxes on the conversion, because the money that you have to pull out of the Roth is actually most of the time going to be considered an early withdrawal, which means you might owe penalties on that money. So not necessarily suggested. You want to more or less have the money sitting aside in a savings account and be ready to pay that bill when you decide to start converting money. So people tend to maybe do this over years, a little bit every year. So if somebody's got a $50,000 account, they might do it over a 5-year period because they don't want to come up with an $11,000 bill like what John may have had in the previous scenario. So just understanding your tax implications are going to be very important. Determining the conversion amount, again, talk with your financial professional or an accountant on this matter, but I like to take this into consideration when you're looking at a holistic financial plan. So what are you going to need the money for in the future? When, how often, for how long? Those are all the questions that I would be asking myself if I was trying to determine how much I should be converting. I put my own money where my mouth is. I actually don't have a single dollar in traditional IRAs at this moment because I like the idea of getting the tax bill out of the way now to know it's going to grow tax-free in the future. And there's been too many conversations about the government wanting to take the Roth off the table as well. So if you haven't already opened up a Roth IRA, you'll want to do that. You'll either want to reach out to an outside custodian from where your IRA is or at the same custodian. It might be able to be done internally if that's what you would prefer. But you would want to contact your IRA custodian as well to let them know what's going on. Now, choosing the method that you want your check delivered to you in. So when you contact your IRA company, they're going to either do one of two things. They're going to send the money directly to your Roth account, or they're going to do an indirect rollover. And an indirect rollover is just where they cut you the check, but you'll want to make sure that you get that check deposited within 60 days from the situation or from the conversion. That is going to be probably of utmost importance if you decide to go this route. So the safer route more often than not is going to be the direct rollover, so you don't have to worry about losing a check in the mail or somebody not putting a stamp on the envelope and those types of things. So after that, you'll want to complete any necessary paperwork. And again, you'll want to be prepared to pay the taxes on the conversion. And then reporting the conversion, depending on if you're working with an accountant, you would want to notify them of what you're doing and why, and have the advisor involved, in my opinion, on discussing the concept and why it's applicable to you. In the event you are filing your own taxes, you would need a Form 8606 in order to have good record keeping, because in the event you got audited down the road, you would want to be able to justify what you did and why you did it and what taxes were owed and what taxes were paid, et cetera, et cetera. And then lastly, after you do this conversion, you'll want to go ahead and get your funds reinvested so they're working for you. Now, there are some rules and limitations around a Roth IRA in general, which I want to hit on before I leave you today. Contributions, there are 3 types of money inside of a Roth. A contribution is what you're consistently adding, or if you add in as a lump sum from your own bank account, not including conversions at the moment. So these are dollars that you can add from the bank account. Now, in 2024, the IRA contribution limits per person, IRA stands for individual retirement account. I've found that a lot of individuals were not aware of that. Is $7,000 per person. Unless you are 50 or older, then you can contribute up to $8,000 for the year. Now, this is between IRAs and Roths. So if you put $5,000 in a traditional IRA and you are age 52, you are only allowed to put an extra $3,000 either into an IRA or a Roth IRA. It's not $8,000 per account. It's per person collectively between IRAs and Roths. Now, there are income limits for contributing the traditional way into a Roth. If you are single and you're making more than $146,000, there is a phase-out limit, which I've gone a little bit further in depth in on some other videos. Or if you're married filing jointly, if your household's making over $230,000, you can't just use we'll call it the front door way of contributing money into the account. You would actually have to incorporate a backdoor strategy, which is what we're going through today. So if you're making above that limit, it might just be a couple-step process where you have to put, in short, a non-deductible contribution into an IRA and then convert it in the event we're talking about contributions. Now, conversions are a different thing. So there are 5-year rules tied to Roth IRAs. The first one is unknown to a lot of individuals I've come to find, is that there is a first 5-year rule, meaning you must wait 5 years after your first contribution to start withdrawing any earnings out of that account. So let's assume somebody is 60 years old and they want to start adding money to a Roth IRA. You're technically supposed to wait 5 calendar years before you start taking those earnings out of the account. You can always take your contributions out the next business day after you add them to the account, but any earnings, again, you would want to leave in there. The next 5-year rule is going to be the conversion rule. So each conversion has its own 5-year period. So if you do this multiple times over many years, for example, the conversion starts on January 1st of the calendar year that you made the conversion. So again, December 18th is today's date of 2023. If I converted a $10,000 IRA into a Roth IRA for this calendar year, I would get to claim January 1st as my first day of my years that we're going to have to count. So January 1st of 23, 24, 25, 26, and 27. So January 1st of 2028 would be the first calendar year that I could touch that money that I have converted from an IRA. Now, there are potential penalties for early withdrawals. Your contributions, you can withdraw your contributions at any point in time, tax-free and penalty-free. So you can put $1 in a Roth IRA today and then take it out tomorrow, hypothetically, and you're going to be fine. Again, it's any earnings you would want to leave in there until 59.5 in order to avoid any 10% penalties on those earnings. Now, converted amounts, they can also be withdrawn tax-free, but you might want to do it after the conversion 5-year period, because if you don't, there could be a 10% early withdrawal penalty on those dollars as well. So the key points to consider in all of this are: consider your contributions and your earnings for the year, determining where your tax brackets are presently. In the event you decide to do a Roth conversion, you want to keep very good records of when you did it and how many dollars you completed this by, in the event you need to pull out money early in the future. And then there are always exceptions to the 10% free penalty rule. For example, if you are a first-time home buyer, you can take some earnings out prior to 59.5, and there are some other options which I've gone over a little bit more in depth in a previous video. All right, so pros and cons of a Roth conversion. First, let's look at the pros. There is a tax-free retirement income that is generated from Roth IRAs. So with that being said, that is probably the single biggest advantage, again, in my opinion, as a financial professional. There also is another advantage of not being told that you have to take money out of your account, so no required minimum distributions. There are also some estate planning benefits inside of these. So Roths can be very, very effective in leaving a tax-free legacy for the family. For example, in the event you have an IRA and you die today, your heirs will have to accept that money either via paying taxes on all of their inheritance today, or they'll have to pay it over a 10-year period, or wait until the 10th year, or any combination of the three. They have options, but they're told they do have to take that money out based off of a 10-year rule, at least as of the making of this video. Now, there is some flexibility as well inside of the Roth, where you can withdraw your contributions, but not your earnings, as we had discussed, anytime without any taxes or penalties. Whereas an IRA, once it's in there, you got to wait until 59.5, unless you have a unique situation come up. As I mentioned earlier, maybe a first-time home buyer, any medical situation. It also can be used for education in some instances as well, but make sure to talk to your tax professional to make sure that that would be applicable to you prior to taking anything out of an IRA or a Roth themselves. Now, some of the cons. So there is an upfront tax burden on any monies that you decide to convert with this situation, so be prepared to pay those bills. There is a 5-year limitation, as we've hit on a couple times now. That can be considered a con because you don't have immediate access to that money, whereas a contribution you do. Market risk is another risk or a con inside of considering a Roth conversion. If our account's worth $50,000 today and we convert it, and then tomorrow the stock market drops by 20%, you're still going to owe taxes on what you converted, not the initial account value by the end of the account year. So that's one thing to consider. And irreversibility. You cannot take this back once you have done it. So make sure you've done your due diligence and spoken with your financial professional. I'll jump to the next page. Please contact your financial professional to determine if this concept is applicable to you for the tax situation or the tax conversation mainly. So in recap, we talked about 5 different things today. We defined what traditional IRAs are, Roth IRAs, and then Roth conversions. We compared a simple scenario of John Smith, where he might consider either not converting an IRA or converting an IRA and the overall tax implications of that. I gave you a step-by-step guide on how to complete a Roth conversion if this is something you would like to do on your own. In the event you'd like some help, we would be happy to help. My contact information is below. And then we reviewed some rules and limitations. And lastly, we discussed some pros and cons of this concept. So in the event you derive value from this video, I hope you consider sharing it with some friends and family, maybe even clicking the like button, because when you do that, it does prompt this video to be dispersed amongst many more people who might derive value from the information. So I appreciate your time today. I hope you enjoy the rest of your week. Thank you very much.